And welcome to Creative Finance. And in this episode, I'm going to be telling you about the AI hype cycle and what you need to be aware of, the silent wealth killer for creators and all of us, but the things that you don't know about and what you need to be aware of with your creative business. And I'll be wrapping up a new way to think about financial independence called the 5, 4, 3, 2, 1. Let's go. This is Creative Finance, the only financial planning podcast built for creators by a creator. Here's what most financial advisors will tell you: get a proper job with a steady income. Here's what I'll tell you: being a creator or digital entrepreneur could make you wealthier than any 9 to 5, if you know what you're doing with your money. My name's George Agan, I'm a creator and chartered financial planner, and this is where creative freedom meets financial freedom. Hi, welcome back to Creative Finance. So just to give you a bit of a heads up, I'm thinking of potentially experimenting a bit with the format of what I put on YouTube. At the moment, the full podcast goes on to Spotify and to YouTube. I'm considering at some point making some more specific YouTube kind of content. Some of you may know I have my own YouTube channel. It's called Principles Personal Finance. Had it for years, and it's been set up and designed for a different type of person. It's kind of retirement planning, all the kind of the traditional financial stuff, and it drives all my clients, if I'm being honest. That's kind of how I got into being a creator beyond my professional music days. Now, the videos I make in that, they are pure YouTube content, generally about, between 10 and 15 minutes. With Creative Finance, I want these. I do love podcasts. I love the depth. I love the fact that I can do stuff like this and just talk, openly to you. But I'm mindful with the YouTube algorithm, especially the setup that I've currently been doing where it plays the podcast intro, it might not be good for retention, kind of engaging people straight away. That's why this one I did a bit of an intro. So what I might be doing going forward is just experimenting a little bit on the formats. I'm going to make sure I keep a long form on Spotify, and I'm not doing this immediately because I've got a few interviews coming up which are really exciting, including one with the bookkeeper. I'm looking to get one with a special interview on family investment companies, talking about some unknown things about your SIPs that you can do, including purchasing things like commercial property and how these deals are structured. So there's loads of and also with my accountant, so we can talk about the things that most digital entrepreneurs don't know about their accounts. So there's loads of really exciting bits coming up. But I just wanted to flag that in advance. If you see a bit of a change of format, it's because I'm experimenting. And of course, if any of you listening have any thoughts, my email's george@creativefinance.co.uk. So to recap, if you don't already know, the format of this show, we split it into 3 bits. It's markets. I just give you a quick update on what's going on with the markets. Nothing too in-depth, try and keep it under 10 minutes so I can just let you know about what my thoughts are and what's going on at the moment. We'll then dive into the core creator topic, which is on the silent wealth killer for creators and digital entrepreneurs. And then I'll talk about wealth wisdom, which for the final piece is what I call the 5, 4, 3, 2, 1, a new way to think about your own financial freedom. So let's go into markets.
My question is, how do you time the big market moves so well?
We haven't the faintest idea what the stock market is going to do or timed anything.
So today I'm going to have a brief conversation about AI. There is a lot at the moment in the news around an AI bubble, and I'm not going to do a deep dive. I could do an hour show on a full deep dive, and maybe I will at some point. But I just want to talk very briefly about AI, and the way to think about it is certainly in relation to the markets. So why are people concerned? Well, I'll put on the screen now, but just for the podcast listeners, there's a metric called the Shiller-Cape ratio. It stands for cyclically adjusted price to earnings. What it basically means is the price to earnings is a key metric of valuation with stocks. And what it does is it gives us a really good idea of what's the price you're paying for the investment versus the earnings. I've discussed this in previous episodes here on Creative Finance, but very simply, if you purchase an investment, you would expect what you pay for it versus what you get in income from it to have an impact on the return you're going to get over time. Stocks are no different. And what the cyclically adjusted price to earnings ratio does is it looks at 10 years worth of earnings and smooths it out. And it can give us an idea of how valuations are drifting over time in a way which isn't impacted by single one-off years. It's a more consistent metric of the smoothing of valuations. And the cyclically adjusted price to earnings ratio for the S&P 500, which is the US's 500 biggest companies, is starting to creep up to the same level that it was around the dot-com crash. So the dot-com crash happened from 2000 to 2003, and we saw an enormous amount of hype around the internet and it was led to significant valuations in companies that had no real underlying earnings or nothing really substantive. Companies like pets.com and even great companies like Amazon got caught up in it. And it was an incredibly painful period for investors. The market was underwater for the best part of 3 years. So people are seeing what's going on in AI, and they're seeing that valuations are creeping up, and they're seeing the concentration that's happening in the US market. The fact that because of cap weighted indexes, basically the indexes, you invest more into the bigger companies as they get bigger. And because tech is taking over the world, people are getting more and more concerned in relation to valuations and the concentration in the markets. The thing is, this other bit of info really drives this home. They are right to have a degree of concern. When we look at CapEx, which is basically what these big tech companies are spending to get towards trying to win the AI race, it is ridiculous. If we have a look at Amazon, Google, Meta, Microsoft, Oracle, they have been investing an enormous amount, and they're expected to reach 500 billion in investing in 2026. This trajectory is expected to continue going forward as well. Just to give you a bit of a sense of it, this next bit of info really kind of blew my mind. When we look at the contribution to the economy, to the US economy, that the investment in AI is making to what's called GDP, which is gross domestic product. Think of it as the entire everything that the economy produces. Investment in AI in one of the quarters led to a 2% uptick in GDP. That is huge. That is basically saying that what's really driving forward a lot of the economy is this investment in this new technology. It has been said that America's market is just a giant bet on AI, and the giant bet that these tech companies are going to continue to dominate, and the promise of what AI is going to do to our futures is going to get realized. Now, where the concern comes from is not only humans just having natural memory on things like the dot-com bubble. When we look at previous technological revolutions, whether this be railways or electricity or even canal boats, what you tend to find is that yes, they do develop world-changing technologies, but actually for investors, there is the benefit of the initial hype cycle, but long-term, because of the level of investment that the investors have to make, they can often lead to disappointing returns to the end investors. That's not to say it's not world-changing technology. That's not to say that it doesn't make a huge difference to people's lives and is seen as the thing that changed everything. But purely from an investment point, sometimes the returns can really disappoint. This has been compounded by other concerns around circular deals. So if you're watching, I'll put a quick graphic on the screen. It's a bit of a mess, but what it's basically showing is it's showing that because of you have companies like Nvidia, who are the chip makers, and then you have enormous investment from companies like OpenAI, and that's linked somewhat to Microsoft. They're also doing huge investments in Nvidia and so forth. You're having this position where the ecosystem of AI is very reliant on itself. That all makes sense. That's absolutely fine. But the Warren Buffettism, you only find out when the tide goes out who's been swimming naked. And I think that is going to be very true of AI. It's all well and good if investment continues to increase at this level, and it could continue to increase in this level for years. I'm not trying to time this. I'm just saying it's understandable that people are slightly concerned on the bubble-esque nature of what is going on, because the investment is huge, the profits are yet to be realized, the deals are quite circular. It does make sense to be concerned. However, here's the thing I want you to think about, because it's what's on my mind. And I'm, just to be clear, not ever trying to predict these kind of things, because nobody can. It's often the stuff that you don't see that gets you. And with the AI bubble, everyone, be it finance content creators, be it the mainstream media, everyone is talking about AI bubbles. And the question is, with this much awareness in the markets, and very recently, I think this is the really interesting bit that's come out this week, we're starting to see a lot of the tech companies report their earnings, be it Amazon's or Microsoft, and the immense investments within AI have been actually taken quite badly from the markets. So effectively in 2025, you could, when these companies' earnings were coming out, as long as they were investing heavily in AI, the market generally saw that as a really positive signal, because the market effectively said, well, we believe this is going to be a winner takes most environment. If we see enormous investment into AI, that's going to be a positive thing. In 2026, At the moment, the narrative looks like the opposite is true, which is effectively that overinvestment in AI, or very significant investment in AI, is seen with some caution and hesitation, as opposed to it being a great thing for the stock price. So going back to my point, considering the level of awareness and perhaps even starting to become a bit of skepticism around AI investments, are we actually going to see the bubble pop? Is this actually going to lead to a bubble pop at this moment in time? If we think this back to events like 2020 and COVID, it was the unexpected nature of that caused such a severe downturn in the markets. Events in the markets which have caused that previously is like 9/11, complete shock event. When there is so much expectation that is getting built into what's going on here, are we actually going to see that pullback? Or are we as market participants, just when we're talking about an AI bubble, effectively building in the expectation that there may be overinvestment, which that in turn may actually mean that instead of it being an almighty crash or pop in the bubble, it's more of a slow deflate if anything does happen. Nobody knows, but I think it's an interesting thing to think about as far as market pricing awareness. Give me some food for thought when we're talking about AI investment. So let's move on to the core creator topic today, the silent wealth killer for creators. Okay, so what is the silent wealth killer for digital entrepreneurs and creators? It is clearly, as it is with everyone, it's inflation. And this is not just going to be kind of the standard stuff that you hear. This is going to be very specific. And I really hope by the end of this, you're going to have a much more in-depth understanding of one of the most fundamental pillars to your wealth. So inflation, what is inflation? Let's break this down firstly. It's the increase of goods and services over time. It is very healthy for there to be a degree of inflation in the markets. In fact, if you have deflation, what that can mean, it makes more sense to hold your money under your mattress than actually spend it, because your money is becoming more and more valuable over time. The most recent inflation reading was 3.4%, and that's consumer price index in the UK. But I think this disguises a much more painful reality. So let's just recap where we stand in 2026. The most recent reading of consumer price index, which is a basket of goods, reads it at 3.4% in December. There's been a 21% cumulative rise in consumer price index since 2021. And in the UK, we have the highest inflation in the G7 nations. However, inflation is like an average, and anyone who knows anything about maths knows that averages do not tell the full story. If we have a look at services inflation, so this is things like actually going out to eat or getting any sort of service, that's 4.5%. If you have a look at food, that jumped 30.6% from 2021 to 2024. So if you've had the experience, like so many of us have gone, well, I certainly have, where you go to do a food shop and you're like, oh my God, it's got so expensive. It's because the averages don't paint this picture. There's certain areas of the market where we see much larger upticks. There's a lot of reasons for this in the UK, whether this is post-Brexit trade friction. We in the UK don't have energy independence, so we have one of the most expensive energy setups in the G7, which causes enormous inflationary pressure on us. But the one thing I want you to think about is your personal inflation rate. So what is your personal inflation rate? And your personal inflation rate is, forget CPI, forget RPI. That's not your lived experience, and personal finance is more personal than it is finance. You have to understand how all the pieces of the puzzle fit together in relation to your own personal situation. If we just have a look at some things that you might be spending on as a digital entrepreneur, software subscription, if we have a look at SaaS prices, they've increased 11.4% in January 2025. That's 5 times higher than general G7 inflation. So I'm an Adobe subscription holder. That plan has increased an enormous amount. So there's also huge geographical differences. So if you're renting at the moment, then London rent has been 9.9%, so way above inflation. We've seen that in different pockets across the country as well. If you, for example, have a co-work, that's increased enormously. Rent is now about 35% of income. Another area of inflation which people don't really think about as much is what's called shrinkflation. So because inflation, the headline figures have been really quite painful for so many people over the last couple of years, one of the things that a lot of companies are now doing is basically just making their products a bit crapper and a bit more rubbish. So Quality Street, for example, has reduced an enormous amount of chocolates which are in the tin. You may have seen different kind of sized bars and all the rest of it. And this is just another form of inflation. It's just instead of them inflating the price, they're reducing the amount that you get, the amount of the good or the service. So what's the insight here? Well, though the general consumer price index may be 3.4, the things you're actually spending on, depending on your expenditure, you might find your SaaS pricing has gone up 11%. You might find your rent has gone up 10%. All these things are actually going to be the things that are going to drive your personal inflation rate. And inflation compounds just like wealth compounds. One of the biggest areas that I see, speaking with digital entrepreneurs, is actually sometimes having a large amount of money in a corporate bank account. And often this can have really poor levels of cash. Now, if this is even a couple of thousands or a couple of tens of thousands, that's not a problem. But I know some who have been holding hundreds of thousands in cash with the bank account, mainly just because of inertia and because they're so busy. Now, there is a solution to that. There are many cash providers now at the moment that work with corporate bank accounts, where what you can do is the technology is effectively that you set up an account with these individuals. The reason why I'm not mentioning names, by the way, is because it might land me in hot water for regulation purposes. But you can easily find them online. And what they will then do is their technology, their proprietary technology, will then split the cash in various different bank accounts, which can make sure that you keep yourselves under the FSCS protection, which I believe is now 120,000 per banking institution. So let's say you had £500,000, you can then split it in different accounts so that you're fully FSCS protected, which you wouldn't be if you just hold it all with your single bank. But it's not just protection, it's also to do with the rate. So ultimately, you can then look at positioning it with the best available rates. You can swap accounts easily. The whole tech platform is designed to make that much easier. Now, if you are somebody who's got hundreds of thousands on the balance sheet, just effectively sitting there on 1-2% interest, that 2% increase in interest that you may be able to achieve, that could be significant money. And a good way to at least maybe not beat inflation, but at least make sure that you're not having your cash eroded significantly by inflation. So what is the insight here around personal inflation that I want you to think about? Firstly, the headlines are not the reality. Your situation may vary. Your personal inflation rate might be lower than the headline, but probably unlikely. The way that you have to deal with this is you have to take responsibility for your own personal finances and track. And this is boring, but there are lots of apps out there that can do it and can track it on your behalf if you're someone who just hates a spreadsheet. But I do this myself personally, and I would strongly recommend it, where effectively build a list of your core bills, your discretionary, understand the different components of your expenditure. Get a spreadsheet, save it in files on your phone. It doesn't really matter, but you do need to have this core level of understanding, and then you need to update it every year or two. Now, for me on my banking app, this is relatively easy because it just has all my direct debits listed, and I've got my little spreadsheet, and I'll just update it, and it will give me an idea of how much more expensive things are getting going forward. The reason why that's so important from a planning perspective is that if we're anchoring to financial freedom, one of the biggest mistakes we could make is planning for, say you need £4,000 a month today. If you don't ever actually then continue to monitor it, you could continually be anchoring to £4,000 per month. Maybe you might think you'd hit your number to achieve it. And then you might come to go to the point where you actually want to start drawing down your money and go, actually, hold on, I need £5,500 a month just to live the life that I've become accustomed to. And the mistake might not have been on your maths as far as how much is enough. Your mistake wasn't updating. So what's measured gets managed. And I know it might be boring, but 100% it's so important you keep an eye on your personal inflation rate. So let's move on to what can we do about it apart from just making sure our cash is working hard enough. Well, let's look at the evidence. Over 125 years of real returns shows us one thing that's very clear. Equities, as far as investing in the great companies of the world, that is the growth engine. If you had £1, even in the UK market, which is one of the less impressive markets when we look at all of history, and then you continue to have that invested after adjusting for inflation, as of today, from 1900 to 2025, you'd have £507 inflation adjusted if you'd been invested in equities. If you'd been in bonds, these are IOUs to companies or governments, you would have had £3. And if you'd had cash, you would have had £2. And I want you to think about that gap, the gap between equities and bonds and cash. What does that represent? Because in my mind, that represents freedom, choice, independence. There is a trade-off with equity investing. You're going to see more volatility, you're going to see more uncertainty, but it is the price of admission for these returns, and it's that which makes your money work hard for you in the long run, and it's that which is going to make sure that you have enough money for the rest of your life. But of course, you need to be comfortable with the level of risk you're taking. So this is one thing that so many people misunderstand about investing, and it can lead to some really expensive mistakes if they get this wrong. And it's about understanding the differences, because it's all well and good me putting a big chart up saying that equities over the long term beat any other asset class as far as giving you a return above inflation. But the thing that's often misunderstood is that when inflation spikes significantly, equities can also perform badly. And this sometimes causes people a bit of confusion, a bit of panic, like, hold on a second, I thought equities were supposed to protect against inflation. How come now inflation's gone to 10% and my equity's down? And this is where we have to really look under the hood in relation to what's called correlation of asset returns. And this is just a fancy way of saying, when we see inflationary spikes, how do these assets react? And when we see inflationary spikes, I'll just leaning on the incredible data here from the Dinson, Marsh and Staunton range set from 1900 to 2024, they look at different asset classes. And what we find is that when inflation bonds do terribly, in fact, a mixture of equity and bonds don't do well. Even inflation priced bonds don't tend to do that well. And the reason why is because bonds in general, if you imagine what inflation is, it's the fact the currency becomes less valuable. And what a bond is an IOU that they're going to return you back some currency. So let's take it to its most simplest example. If you purchase a gilt, which is a bond, it's an IOU from the UK government, then what that's happening is the UK government is saying, I'm going to return your £100 and I'm going to give you some interest as well alongside that. Now, if over those 2, 3, however many years that bond, however long that bond is there for, that there has been significant inflation, that £100 you're going to get back after we adjust for inflation, which is the only key metric for wealth, is going to be worth much less. So what we find is that bonds actually aren't very good in high inflation environments, because ultimately your currency gets eroded. Equities, they do well over the long term versus inflation. But when inflation spikes to say above 5%, equities don't perform that well as well. And the reason behind this is that ultimately what happens is that when equities are priced, when you pay for a stock, implicit in that, as far as kind of built into that price, is an assumption around inflation. Governments around the world try to target inflation somewhere between 1 to 3.5%, depending on which government it is. And the reason why is that that's generally the sweet spot where you get a little bit of healthy growth of an inflation across the economy, but not so much that people start rioting because things have become so expensive. So what's the insight there? Well, the insight there is that when inflation goes, say, above 5%, this is typically because of unexpected inflation. People aren't wanting inflation to be this high. So the pricing expectation that's built into the equity, that's unexpected. And as a consequence of that, that means the pricing expectation has to readjust. Basically, the market has to go, oh crap, we didn't expect there to be 10% inflation. So we have to now discount back the cash flows that the equity is going to provide in a different way. The market says the facts have changed, so the price of your equity is going to have to change as well. And that's why, though in equities are a good long-term asset to increase above inflation, over the short term, you will see declines. And that's exactly what we saw in the markets between 2022, roughly when Russia invaded Ukraine and we saw the inflation spike, and then when inflation started to come down. There's also often a dynamic that interest rates are rise to combat inflation. That's what central bankers do. They try and combat inflation by increasing interest rates. And that has an impact on equity and bond pricing as well, because governments set what's called the risk-free rate. So if you think about having money lent to you from the Bank of England, if they are offering you 2 or 4% on the interest rate, that is risk-free because they can basically just print more currency. And what that means is that if they go from an environment where they used to offer you 1% to over 6 months now offering you 4% on what they're going to pay, which is exactly what happened in 2022 when the Bank of England and the Federal Reserve in the US quickly raised interest rates, then all of the pricing of the assets around the risk-free rate, like bonds and companies like Google, Amazon, whoever, they're all going to have to adjust because the central bank rate is the tide that lifts or drags down all boats. So as far as what is more correlated to inflation, it tends to be commodities. Gold does have a minor correlation, but as I mentioned in the last previous episode, it can be quite spotty as an inflation protection. The truth is, there is no one single fix with inflation. Sometimes commodities do well, sometimes gold. But the key dynamic you need to be thinking about for your own personal finances is how important is that short-term protection to you? If you are really sensitive to inflation, then there can sometimes be a case to put in things like commodities into a portfolio. But if you're thinking more long-term protection, this is the position I'm in, I'm not too bothered about throwing in some commodities or some gold into a portfolio in the hope that it gives me a little bit of short-term inflation protection over the next 3 to 5 years, because my belief is, looking at all the history of the data, is that yes, you'll have these spikes where equities might underperform over the short space of time, but if my time horizon can be 10 years plus, then it's better just to hold the equities so that they provide higher returns when inflation eventually falls. So, how can you build an inflation resilient life and portfolio? Well, there's kind of the core engine where, as long as you're comfortable with this level of risk, global equities give us the highest chance of return over the long term. And of course, we want to be considering tax efficient wrappers like ISAs, SIPs. You can invest within your company if you need be. If you are going to invest in the company, it's important to make sure that you've done that right with the good advice. And if you're going to have large amounts of money in cash in your company, it's worth occasionally auditing this if the cash gets to a high level and making sure that you are getting a rate which reflects what the market is able to provide. You can, in your portfolio, consider things that are going to give you some inflation protection. That would typically be things like commodities, sometimes some gold. But remember, in doing that, what you're prioritizing is you're prioritizing short to medium term inflation protection at the cost potentially of long-term inflation protection around equities. And then you have your own personal finances, where you need to understand the impact of inflation and how this impacts your income and expenditure over the long term. Is your personal inflation rate running at 10% where inflation is running at 3%? Well, at least if you know that, you can make better informed decisions instead of just keep looking at your bank account and going, why am I poorer? Why am I poorer? What's going on? And it might be because your personal inflation rate has gone well above the rate of inflation that you've seen in the headlines. So what other actionable steps could a digital entrepreneur take? Well, audit your exposure, raise your prices. I know that seems unpopular, but look, we're business people here. If your prices need to keep up in line with your lifestyle and also the cost of the economy, you have to sometimes make these hard decisions. Minimizing your tax bill and maximizing your tax relief is a great way to try and maintain your wealth above inflation. Tax drag is real and it is just another cost. So in reducing your costs, you're maximizing your post-inflation return. Investing for the long term, or certainly looking at segmenting your assets so that they're appropriate for the right time horizons. Stress testing your financial plan. So I'm going to do some episodes going forward where I actually go through financial plans. So I think that's going to be useful. But certainly what I do with clients is we always stress test against a higher inflationary environment and then align your time horizons. Have you got cash which is sitting on the sidelines you could be using? Is your long-term money going to be getting you the best long-term returns? So I hope that taught you something maybe you weren't aware of in relation to the impact of inflation on your money as a creator or digital entrepreneur. Let's go on to wealth wisdom. So the wealth wisdom topic, which is just going to be a very quick one really, it goes back to the idea of making sure you have a theory of wealth. And I want to talk to you about one of the things that I've been throwing around my own mind, and it's called the 5, 4, 3, 2, 1. So many of us, we build our lives and we sacrifice today for the hope of tomorrow. And in doing that, we're making trade-offs, aren't we? We're assuming that if we want to work 60 hours a week at the moment for potentially better tomorrow, that we're going to be there tomorrow, and that the life that we build tomorrow is going to live up to that expectation. And I often think all the time, and it's because I'm dealing with people every single day about how do we get to financial independence, how do we maintain financial independence. And I've seen a lot of people who, especially for those who have been driven all their lives, they get to 60, they retire, they go sit on the beach, and they just become a bit lost, if I'm being honest, especially for those who have been living all their lives, often working with teams, sometimes quite high stress roles. And you go from a team of maybe 50 people under your beck and call to not being able to get a plumber to turn up once you've retired, because you go from this big person to somebody who has a huge drop in status. Now, of course, you have money and you've got time, you've got all those things, but we humans, we're creatures of habits. So I want you to just think about what that life looks like to you, as far as not just, getting to the point that you're working on your own terms. That's the dream for everyone, let's be honest. How do you balance getting purpose so that you've got enough to get out of bed in the morning? And the way I think about it is I like the idea of what I call a 5, 4, 3, 2, 1. I think this is me. I don't think anyone else has come up with this. But when at the early stages of life, working 5 days a week, if not more, is probably ideal. You've got to build your wealth. And unless you're fortunate enough to have kind of generational wealth, most of us are going to have to really put in the hours to get there. But instead of doing what the baby boom generation did, and they say, right, you get to 60 and then it's a full stop and, just hope you don't have a heart attack on the beach. What happens if you just staggered your financial independence as you went through? So as you can imagine, the 5 starts 5 days a week. Then at some point, maybe when you hit 40, maybe before, depending on what you like to get out of life, you drop to 4 days a week. And then a decade later, you drop to 3. And then a decade later, you drop to 2. And then you're in your 70s and you're finally down to 1 day a week. The reason why something like this really resonates with me is that, certainly from a family side, if you do 5 days a week, it's very difficult to find any time to do anything. And I would love to be in a position in a couple of years where I feel that I've saved enough. It's what's called coast fire, that you can know that when you get to 60, you're going to be in a position that you've already reached financial independence because of your previous saving. You have to assume that markets are going to continue to do what they've done historically, but there's definitely ways you can plan for it. And I'm actually working with some of my creator clients trying to get to that kind of coast fire position. But if we know that you're in that position where, at 60 or whatever your chosen date is, you're going to be okay for the rest of your life, does that mean that we should now consider maybe taking a day off from 40 to 50, so that one of those days, instead of it being 5 days a week and you're flogging your guts out, you're in a position where maybe you can try and take a bit of time back. Maybe you can do some more exercise. Maybe you can spend a bit more time with the family, because you are not guaranteed to be healthy at 60 or 70. So we need to try and strike the balance throughout our entire life instead of just waiting for some day in the future. Now, ideally, then going forward in your 50s, maybe drop an extra couple of days and have a bit more time freedom. And the reason why I like the idea of continuing to work even to, as I get much, much older, is that I do like working, which also means that I might be full of shit with this suggestion, because I'm the kind of guy who will work weekends and all the rest of it, because it's just how I'm wired. And my suggestion is not to say that this should be the path that you use for your life. My suggestion is you should be thinking about what path you want to take and the trade-offs for tomorrow versus today. Because we shouldn't be living our lives on the expectation that we're going to have a certain type of life in many decades. We're not promised that. But also, we shouldn't be living in accordance to the expectations of the generations prior. And sometimes being a bit more thoughtful about how we can approach this can unlock things that we might not have expected. So I just wanted to leave that with you as something to think about. What is the right structure between the work and play and family and everything in between? And are you getting that balance right? Thanks so much for watching.